Hey, how's it going, guys? If you ask professional fund managers how they value a company, one of the most common answers you will probably hear is definitely the discounted cash flow. It's an extremely powerful valuation model to calculate the intrinsic value of a business. However, most of the new investors still struggle to fully understand how it works. So in this video, I will simplify the whole process and help you guys fully understand how the discounted cash flow valuation works. Also, I will show you guys step by step how you can build an easy to use discounted cash flow model and calculate the intrinsic value of almost any stock in just a few minutes. Knowing how to use the discounted cash flow model to value a business is definitely one of the most important skills you need to have in the world of investing. So please make sure you watch the video to the end and do not miss out anything. I promise you I'll make it quick and don't waste your time. Alright, let's get started. Valuing a company using discounted cash flow model is probably the #1 core skill in corporate finance. No matter if you want to build a career in the investment banking, or a hedge fund equity analyst, or even just a part-time retail investor, DCF model is probably the most important and must-have foundation to help you achieve your goal. So what exactly is the discounted cash flow model and how it works? Warren Buffett once famously said, "The intrinsic value of a company today is worth an amount that is equal to the total sum of all the future cash flows it can produce, with each of those cash flows being discounted to today's present value." We can translate what Warren Buffett said about a company valuation into this formula, and this formula is no other than the famous discounted cash flow formula. To break it down, DCF is the sum of all the future discounted cash flows that the company is expected to generate. This is also the intrinsic value of a company. So whenever you hear someone talk about the intrinsic value, this is what they actually mean. CF is the cash flow of any given year. R is the discount rate. It is basically the target rate of return that you expect from investing in this business. To understand the discounted cash flow, the first concept that we need to understand is the time value of money. $1 today is always worth more than $1 tomorrow. For example, if you have a friend offering you a small guaranteed reward of $1,500 in 3 years' time and ask you how much you are willing to pay for that reward today, to answer that question, you need to translate that $1,500 into today's value, called the present value. And the amount of present value depends on what rate of return you can compound your money to grow during that period of 3 years. If you can generate an annual return of 14.5%, then the $1,500 in 3 years is only worth $1,000 to you today. If you can generate a return of 7.7% per year, then that $1,500 in 3 years worth $1,200 to you today. Your target rate of return can determine the exact maximum amount of money you should be willing to pay today for that $1,500 rewards in 3 years. So once you understand the concept of the time value of money, then you will be able to understand the whole idea of the discounted cash flow model. It's simply to calculate the present value of all the future potential earnings that the business can produce in the future. When you are buying shares of a company or even the whole business, analyzing the expected discounted cash flow is one of the best ways to help you decide which investments are worth your money and how much money you should pay for it. Now let's take a look at another example. You have a friend offering you to buy his Shopify online store. His online store business is making exactly $1 million every year after tax. But this online store will have to shut down after 10 years. So how much would you like to pay for your friend's online store business? The best way to value such business and know exactly the purchase price is to use the discounted cash flow model. Let's say you would like to generate a 7% stable return every year from your investment in this business. Then the intrinsic value of your friend's online store is going to be the total present value of each year's cash flow for the next 10 years. Once we apply the discounted cash flow formula, we can calculate the intrinsic value of this business is $4.1 million. So which means with a 7% annual return, if you can pay less than $4.1 million to buy your friend's business, you will get a pretty good bargain. If your friend is asking more than $4.1 million, then you will be overpaying for his business. Of course, in the real world of investing, it's way much more complex than this. For example, in our real life, the business is expected to last close to forever, not just 10 years. Also, each year's cash flow is expected to grow, not fixed. So how can we value a real business and buy their stocks at the right price? I will use Apple as the case study and walk through with you guys step by step how to build a discounted cash flow model using Google Sheets and calculate Apple's intrinsic value for you guys. And after we go through this case study, you will be able to fully understand and apply the discounted cash flow model whenever you want. In total, there are 5 steps to build a discounted cash flow model. Step 1. Forecast the free cash flow for the next 4 years. In order to forecast the free cash flow in the future, we need 2 things. First, the forward free cash flow growth rate that is estimated by the Wall Street analyst. We can get this number easily on Seeking Alpha. I will show you guys how to find it. When you're on the Seeking Alpha website, search for Apple. Then go to the Growth tab. Under the Growth tab, you will find the free cash flow growth forward, which is 4.43%, and that is the number we need. Alright, so the second important thing we need is the free cash flow of the previous whole financial year, which is 2019. There are 2 types of free cash flow, levered free cash flow and unlevered free cash flow. For the discounted cash flow valuation, it is most common to use the unlevered free cash flow. The formula to calculate unlevered free cash flow is to use the operating cash flow and the minus the capital expenditure, or the capex. You can get both of the numbers from Seeking Alpha as well. Under the Financials tab, choose the Financial Statements, then click on the Cash Flow. Make sure it's annually, not quarterly. Then under the cash flow, you will find the cash from operations and the capital expenditures. Those are the 2 numbers we need. We key in these 2 numbers in our DCF model, do the subtraction, and we will get the free cash flow of 2019. Once we get the both free cash flow of 2019 and the forward free cash flow growth rate, we can now calculate the estimated free cash flow for the next 4 years. Alright, step 2. Calculate the weighted average cost of capital, or the WACC. Why do we need this weighted average cost of capital? Remember we talked about the time value of money earlier? The present value of any amount of money in the future will be dependent on how much return you expect to generate during that period of time. And this weighted average cost of capital works the best as the expected return of investing in a business. This is an extremely important number because we need this key number to calculate the present value of all the free cash flow that Apple can generate in the future. Here's the formula for weighted average cost of capital. Basically, it's the total sum of 2 parts, the cost of equity and the cost of debt. The calculation is quite tedious. The whole concept of the weighted average cost of capital definitely deserves an entire separate video to elaborate and a deep dive into the calculation behind this formula. I will definitely make another separate video in the near future to walk through the whole process for you guys on weighted average cost of capital. And in this video, I will show you a quick and easy way to get the WACC number for free. You can go to the website called Guru Focus and search for Apple. And under the 30-year financial tab, you will find the most recent WACC number. We key in this number into our discounted cash flow model and complete the step 2. Alright, let's move on to the step 3. Calculate the terminal value. So what is the terminal value? When we were forecasting the future free cash flow back in the step 1, you probably wonder why we just forecast the next 4 years, not 5 years, not 6 years, not 10 years. The reason is that in the discounted cash flow model, we expect the business will last close to forever, but we cannot keep forecasting the cash flows forever. At some point, we need to make a high-level assumption on the cash flows beyond the final forecast year, and that is exactly where the terminal value comes in. Terminal value is the total value of this business' future cash flow combined after the final forecast period. Usually, we put the terminal value in the 5th forecast year or the 10th forecast year. In this case study, we put the terminal value in the 5th forecast year, which means we forecast the free cash flow for the first 4 years, and in the 5th year, we calculate the terminal value for the remaining of the years. This is the formula to calculate the terminal value. So basically, we need 3 numbers. First, the perpetual growth rate. We assume a company can grow at the fixed rate every year from 2024 to basically forever. Of course, this is the estimated rate of growth. The number is purely based on the investor's personal preference combined with this company's past track record. But there's a rule of thumb. Your long-term perpetual growth rate should be smaller than your forward free cash flow growth rate that you use in the step 1. For Apple, the realistic perpetual growth rate is around 3.8%, which means we assume Apple can grow their free cash flow at 3.8% every year from 2024 to the rest of its lifetime. Alright, once we estimate the perpetual growth rate, then the second number we need is the starting value. The calculation for starting value is pretty easy. We use the free cash flow from 2023, grow at a rate of 3.8% to the year of 2024, that will be our starting value. Finally, we use the weighted average cost of capital that we got from step 2 as our expected rate of return here. Once we get all these 3 numbers, we can calculate the terminal value, which is about $2.1 million. There's one thing you should remember is that terminal value is not a present value. This is a future value. We still need to discount this terminal value to the present time. And that leads us to our step 4, calculate the total present value. For now, we have the free cash flow estimates for the next 4 years and as well as the terminal value starting from year 5. What we need to do in the step 4 is to give each year a discount rate and calculate the present value for each year's cash flow. Getting the discount rate is pretty easy. So here's the formula. All we need to do is to use the weighted average cost of capital that we got from step 2 and compound it for each year all the way to year 5. As the year goes further, we expect the discount rate to become higher and higher each year. Then we use the free cash flow to divide it by the discount rate, and that's how we get the present value of free cash flow for each year. Alright, once we get the present value for each year, we can now move on to our final step, calculate the intrinsic value for the share price. This is probably the easiest step. All we need to do is to add up all the present values that we get from step 4 together as the total present value. And this is also considered as the intrinsic value of this business today. In our example, this is the intrinsic value of Apple today. Then we can use this total present value divided by Apple's total share outstanding. We can finally get Apple's intrinsic share price to buy today, which is about $397. Alright, there you have it, the easy 5 steps to build a discounted cash flow model and calculate a stock's intrinsic price to buy. Here's a quick recap. Step 1. Forecast the free cash flow for the next 4 years. Step 2. Calculate the weighted average cost of capital. Step 3. Calculate the terminal value after 4 years free cash flow forecast. Step 4. Add the discount rate to each year and calculate the present value of the free cash flow for each year, including the terminal value. Step 5. Add up all the present values together divided by the total share outstanding. Then we can finally get the intrinsic share price to buy. Of course, every valuation model has its own limitations, and so does the discounted cash flow model. Estimating all the future cash flows that a business can produce in its lifetime and discounting them to today's present value is both a science and an art. The main limitation of the discounted cash flow model is that it requires making the 3 key assumptions: the forward free cash flow growth rate, the weighted average cost of capital, and the perpetual growth rate. Each of these assumptions is critical to getting an accurate valuation result. Since none of us can see the future, no matter how much effort you spend on optimizing the 3 key assumptions, the unexpected things can always happen to the business and mess up your valuations. That's why the experienced investors normally do 2 extra things when they use discounted cash flow model. First, they apply a margin of safety. For example, if they calculate a stock's intrinsic share price to buy is $50, then they only buy it when it goes under $45. That is a 10% margin of safety. So even if the company doesn't perform quite as well as they expected, they have a margin for error to still get the return they're looking for. Second, they diversify into different types of a business and asset classes. No matter how much work you do, an investment could always turn out badly. By diversifying their wealth into different companies and uncorrelated asset classes, they reduce their potential risk exposure. But regardless of the limitations, the discounted cash flow model is definitely one of the most powerful valuation models and one of the most commonly used by the investment bankers, private equity analysts, and institutional investors. Understanding how the DCF model works and knowing how to use it to value a business can greatly help you to become a more intelligent and a more profitable investor. Alright, that will be the end of this video. If you are new to this channel, my name is Vic. I make videos every week to share some of my thoughts on what is going on in the financial market, and also some educational contents to help your investing journey just like this one. If you are interested in the world of finance and investing and find my videos being valuable to you, please consider subscribing. Thanks so much for watching, guys. I will see you again soon.